Hi, let's try this again. My name is Garrett O'Hara, and welcome to Class 8 Personal Finance. I've had a lot of technical issues trying to get this channel started and recording videos, so you'll have to excuse the fact that I have the audio mixer thing on both of my screens, and if you see it die, you get to watch me troubleshoot in real time. Okay, how do you construct a portfolio between your stocks and your bonds and between your US and international stocks? I see a lot of folks struggle with this. They look at a list of funds in 401k and they kind of go, okay, I'm just going to put even amounts in each of these and not really know what's inside them. So I'm going to do a brief overview of how we do this. Stocks, bonds, those are your two basic asset classes. How do you decide a percentage between each? Stocks are riskier, they also return more. So if you're 25 years old and you feel like you can take all the risk, you could go 100% stocks, 0% bonds, and have all that risk right there. Another thing I want to do with this channel is make sure that folks who watch know how to use a spreadsheet. So I'm going to be showing technical tips as we go along. So what I did here was 0%. All of the highlighted cells here are the cells where I can put in values, and the non-highlighted cells have the formulas in them. So here in stocks, I have equals 1 minus B5, which is this cell right here. 1 minus 0 is 1, which is 100%. So when I was about 27 years old and still active duty in the Navy, I was talking with a colleague about asset allocation and investing, and I told him I was agent bonds. And he goes, "You're in trouble." Okay, he didn't say you're in trouble verbatim. This is the Navy. We have a different dialect if you get my drift. But he thought I said Asian bonds, like bonds from Asia, when I actually said age in bonds. Age in bonds would mean I was 27 years old. Therefore, I was 27% bonds and 73% stocks. That's kind of old advice. It's advice I had taken for a long time, but it's really, really, really conservative, especially now that bonds are almost making, well, I don't say they're making nothing, but they're making not much. You could modify this. You could say age minus 10 in bonds. So a 27-year-old would be 17% bonds. Minus 20 is a sound one as well. So someone who's 27 might only be 7% bonds. But this is personal. It has a lot to do with your own risk tolerance. So think about a range between 0 and 20 based upon your level of aggression. You might even go more than that. Another one is, oh, by the way, I should note I'm 80-20 and I'm 36 years old, just to kind of give you a benchmark. Another benchmark you could use is what percentage are you willing to lose in a stock market crash? A typical stock market crash might have the stocks go down by about 50%. If you think you can tolerate the stock market going down 50%, or rather, if you think you can tolerate your portfolio going down by 40%, 40 times 2 is 80. So you can have up to 80% in stocks. That's one way to think about that. And it's good to have that kind of mental benchmark because here's what you don't want to do. It's not merely a matter of, okay, how much are you willing to lose until it hurts? It's you don't want to be that guy who gets scared because you had the wrong asset allocation and then you take everything out. And you've taken everything out and then the market recovers. What you want is an asset allocation that you can stick with in the thick and the thin. And that might mean going more conservative than you otherwise would because maybe you've never been through a market crash and you don't know what it's like to see all that stuff go down. Now, I've been through a couple market crashes. One was 2008 when I didn't have much in there, so I wasn't phased at all. And the other was the most recent COVID one. Now that we've been through that, so that might be in your recent memory as well, if you were invested at that point. And so you kind of have something to go off to kind of go, okay, can I take that or not without taking everything out of the market? And in fact, I didn't take everything out of the market at that point. I kept on adding in. So I have a better idea now of my own risk tolerance. Let's stick with 80-20 for now. That might be good for you, might be not good for you, but we'll calculate it like this for now. And we're going to switch to US versus international. How do you calculate this one out? There is a big range of opinions regarding this. If you were to talk to John C. Bogle, the founder of the Vanguard Group, who's now passed away, or you talk to Warren Buffett, one of the founders of Berkshire. He didn't actually found Berkshire Hathaway, but is the head of Berkshire Hathaway, and probably the greatest investor of all time. He would tell you just stick it in an S&P 500 index fund, and the S&P 500 is a U.S. only fund. Let me pull this one up here. So the S&P 500 is only this percentage, this blue block, compared to all this other stuff that's on the market. You're missing out on these mid-cap and small-cap stocks. You're missing out on this whole international chunk that's about 40% of the whole world market by going in just an S&P 500 index fund. Now, here's the reason he has behind that. And that is the S&P 500 already has a lot of international diversification, and that's true. Think about the top stocks that are in the US: Apple, Microsoft, Amazon, etc. Where does Apple do their business? Well, it's not just the US. It's in a whole lot of places. Pretty much all over the world, there are Apple devices. And so, yes, there is international diversification in the S&P 500. Now, that said, what are all these international companies doing as well? They're over here in the US. Nestle is here in the US. Toyota is here in the US. And so I prefer, as an American, to just go 60-40. That happens to be the current world stock market weight right now based on the value of all these stocks that are in the market. Let me go back over here. 60-40. Well, let's zoom back in here. US 60%, international 40%. That's where I prefer to be. So that's my answer to the question, but you may prefer less. It's going to depend partly on whether you can take underperformance. The US has been outperforming international by a long shot over the past 10 to 15 years. Now, it's not like international has done absolutely nothing. It's done okay over the past year, but it just hasn't been the S&P 500. It hasn't been the US stock market. So something I'm going to caution about when you have this much international is, can you tolerate the underperformance compared to the benchmarks that you're looking at all the time, such as the S&P 500. The other issue is, if you are not American, maybe this isn't the best advice for you. If you're Canadian and Canada is 3% of the total world stock market, I think it is about 3%. Do you really want only 3% of your investments just in your own country? That might not make a whole lot of sense because you're expecting to retire in Canada and spend Canadian dollars and have a Canadian house and pay Canadian taxes and all that. Maybe 3% isn't the best answer. Maybe you want more than that. But for us who are here in the US, we have the convenience of having the world revolve around us and all that. 60-40, I think, is a good answer. But you might disagree, and that's okay. Now, what would you want to put in these funds? Here's another trick for you in the spreadsheet. So here I already have the same subtraction thing that I had over here in the stocks and bonds. Here's another one. It's called the Google Finance function. Equals Google Finance, and then F2, which is the cell right here. And under the second argument, I have name. So when I put in the ticker that I want here, I'm going to recommend VTI, which is Vanguard's Total Stock Market Index ETF. It already plugs in this ticker symbol. Now, when you're building a spreadsheet and you want it to calculate things for you, it's not going to calculate, and you want to calculate a name. You don't really care about that. You might care about the share price. If you take this out and just use the ticker symbol, it'll actually give you the share price. The share price right now is $222.94. It's delayed by 20 minutes if it's during the trading day, but that might come in handy when you're trying to balance things out and you don't want to plug in all these numbers. If you know the number of shares in your account, it'll give you the share price, and you can multiply from there. Just something to point out. Now, on the international side, standard advice for index investors would be to go with something like VXUS, which is Vanguard's Total International Stock Index Fund, ETF. I disagree with this one, and I'm very much in the minority on this. If we look at this diagram again, I have another video that covers this chart a lot more. So here's VXUS. It's the Total International Stock Index ETF. And you could split this into two. You can split this into developed markets, which are developed Western-type democracies, except Hong Kong. Sorry, guys. And then you have emerging markets like China, Taiwan, and on down from there. I prefer to stay in the developed markets in this context because the emerging markets arena is filled with autocracies, dictatorships, and I'd rather have free markets. I don't think the market properly prices dictatorships, and I was either lucky or correct over the past 2 years with the way China has performed. By the way, I'm recording this during the Beijing Olympics, if that matters. But I made that decision to get out of China a while back. It wasn't during the Olympics. So I'm going to put VEA here for that reason. VTI and VEA in a 60-40 proportion. And note, we have a multiplication thing with our spreadsheet here. B2 times E2 equals, in this case, 48%. Now on the bond side, I'm going to make another video to split out Treasury and corporate bonds. Think about it this way. If you're getting a mortgage, you care a lot about your credit rating. When you're buying a bond, or rather, let's put it this way. The mortgage company cares a lot about your credit rating because it's going to affect the rate at which they're willing to lend you money. When you buy a bond, you are lending money to the company or to the government, and you should care about the credit rating of that government or of that corporation. If you're sticking within the US, and I'm just going to stick with US bonds here and not try to diversify out to international bonds, I'll do another video on that. You should expect a lower return from Apple than you should from Sears Roebuck and Company. Sears is in trouble. They are distressed. So they're going to pay more, but there's more risk involved with that. The US government has a very high credit rating without getting into politics and all that. I prefer to keep these separate. A lot of folks advising with bonds will tell you to put this in BND, Vanguard's Total Bond Market Index Fund, which includes both treasuries and corporates in about a 65 to 35% ratio at the moment. I prefer to have these separate. And in fact, I'm 100% treasuries. I'll do a bond, again, the bond video is where I'll do that. But let's say 50-50 for now. Did I actually modify that? No, I did not. So let's say 50-50 treasuries to corporates for argument's sake, because then you'll know where the risk is and where the risk is not. And we could just put two other Vanguard funds here. You could say, for example, VCIT, which is Vanguard's intermediate term. I did that wrong. VGIT is the government one. And on the corporate side, I can point out a couple of them. VCIT is Vanguard's corporate bond ETF. So it makes about 1% more in return versus the government one. Another one is if you want to keep it to very high quality companies, you could do something like QLTA, which is where I'll leave it here. So note this is AAA to A-rated corporate bonds rather than BBB, which is the next step below and where a good chunk of these bonds are in terms of credit rating. But there you have it. You can see that this comes out for you with 4 different percentages. So if you have a Roth IRA and then perhaps a Roth IRA for your spouse, and combined there, you have $12,000 of room to contribute to your retirement. That's a good way to figure out how to get the percentages to where you want them based upon something that's going to work for you. In other videos, I'm going to be talking about how to combine this with a 401k and try to make things kind of combine together and make them work. But I think I'll end it here and hope that everything worked out technically, because I'm just about out of recording time before my kids wake up and this isn't going to work anymore. Let's hope this works. Thank you for listening. Looks like my microphone's still on, is all that. This has been Class 8 Personal Finance. I'm Garrett O'Hara. If you liked this video, share it with someone whom you think will benefit from the information. Thank you. Where's my mouse pointer? I keep doing that every time.